The Federal Reserve was built in 1913 for one reason: to stop financial panics. 16 years later, it personally engineered the worst one in human history. Not by accident, by vote. The New York Stock Exchange lost $14 billion in value. Not over a week, not over a month. One Tuesday. Men stood on the floor of the exchange and simply stopped moving. Some wept, some didn't. The ticker tape ran so far behind that traders had no idea what anything was actually worth. They were selling into a void, and the institution that was supposed to prevent exactly this, the Federal Reserve, had spent the previous 2 years making it worse. How does the most powerful financial body in the world destroy the economy it was built to protect? Go back to 1927. America was winning. Industrial output had doubled since 1921. Automobile registrations hit 23 million. Radio Corporation of America, RCA, had risen 939% in 5 years. The Dow Jones Industrial Average climbed from 63 points in 1921 to 381 points by September 1929. That is a gain of 504% in 8 years. Department stores were opening on every corner. Installment credit, buy now, pay later, was exploding. General Motors was selling cars on payment plans. Sears, Roebuck was selling houses on payment plans. The American consumer had discovered leverage, and leverage for a while feels exactly like wealth. Wall Street reflected all of it. Investment trusts, the mutual funds of their era, were being created at a rate of nearly one per day. By 1929, Goldman Sachs launched the Goldman Sachs Trading Corporation in December 1928. It raised $100 million in days. The public didn't just trust the market, they worshipped it. Irving Fisher, the most famous economist in America, declared in October 1929 that stock prices had reached a permanently high plateau. The memo was dated 9 days before the crash. So who exactly was watching? Someone was watching. Roger Babson had been watching for 2 years. On September 5th, 1929, Babson stood before a business conference and said it plainly. Sooner or later, a crash is coming, and it may be terrific. The market dipped that afternoon. Traders called it the Babson break. Then it recovered, and everyone moved on. Paul Warburg, one of the architects of the Federal Reserve itself, had warned in March 1928 that unrestrained speculation would produce a general depression involving the entire country. Nobody called it the Warburg break. Nobody called it anything. His warning was printed in the newspaper, read, and forgotten. Beneath the headlines, something structural was fracturing. Agricultural prices had been collapsing since 1920. 600 banks had failed between 1921 and 1929. Not the big ones, the small ones. Rural banks in Iowa and Kansas and Georgia, serving farming communities that were already broke. Nobody on Wall Street was losing sleep over a bank failure in Grundy County. But those failures were a pattern, and patterns, ignored long enough, become avalanches. What the markets didn't know, what the Federal Reserve chose not to emphasize, was that the American economy had two entirely different speeds. One was booming, the other was already in depression, and the Fed's next decision would crush them both. Here is the decision. The specific one, the one that mattered. In February 1929, the Federal Reserve Board in Washington issued a formal warning to its member banks. The directive ordered them to stop lending money for stock market speculation, not by raising interest rates, not by tightening credit economically, by moral suasion, by asking nicely. It was the equivalent of telling a casino that gambling was inadvisable. The banks nodded. The brokers' loans, money lent to investors to buy stocks on margin, continued climbing. By October 1929, brokers' loans stood at $8.5 billion. That is up from $3.5 billion just 2 years earlier. Benjamin Strong was the governor of the Federal Reserve Bank of New York. He was the most powerful central banker in America. He understood the danger. In 1927, he had cut interest rates from 4% to 3.5% to help stabilize the British pound. The move flooded American markets with cheap credit Fed speculation. Strong knew this. His colleagues at the Fed knew this. In 1928, Strong reversed course and began raising rates. The discount rate climbed from 3.5% to 5% by July 1928. Then Strong died, October 16th, 1928, and with him died any coherent policy. What followed was paralysis. The Federal Reserve Board in Washington and the regional Federal Reserve banks could not agree on anything. Washington wanted to raise rates higher and crush speculation directly. New York wanted to buy government securities and manage the situation gradually. They argued. They wrote memos. They held meetings. Meanwhile, the market climbed another 20% after Strong's death. The institution designed to act as a lender of last resort was deadlocked, and October 1929 was 6 months away. Here is how it broke. October 24th, 1929. Black Thursday. Prices began collapsing at the open. By noon, the ticker tape was running 48 minutes behind. Investors were receiving prices for trades that had happened almost an hour earlier. Blind a group of bankers: Thomas Lamont of JP Morgan, Albert Wiggin of Chase National Bank, Charles Mitchell of National City Bank, pooled $240 million to stabilize the market. Richard Whitney, the floor broker for JP Morgan, strode onto the exchange floor and placed a bid for 10,000 shares of US Steel at $205 per share, above market price. Visibly theatrically, the market steadied. The papers called it a rescue. It wasn't a rescue, it was a pause. On Monday, October 28th, the Dow fell 12.8% in a single session. Then came Tuesday, October 29th. Black Tuesday, 16 million shares, $14 billion gone. The bankers' pool stopped buying. Thomas Lamont issued a statement describing the market as undergoing a little distress selling. $14 billion. A little distress selling. By mid-November, the Dow had fallen from its September peak of 381 to 198, a decline of 48% in 8 weeks. And the Federal Reserve's response? Between October 1929 and December 1929, the Fed cut the discount rate from 6% to 4.5%. A gesture. The damage was already systemic. What made it catastrophic, not merely bad, was what the Fed did next. Between 1930 and 1933, over 9,000 American banks failed. 9,000. The Fed allowed the money supply to contract by 33%. Milton Friedman and Anna Schwartz documented this in 1963 in A Monetary History of the United States. Their conclusion was direct. The Great Depression was not caused by the crash. It was caused by the Federal Reserve's failure to prevent bank failures from collapsing the money supply. The crash was the trigger. The Fed was the bullet. Now the human accounting Charles Mitchell, chairman of National City Bank, had personally encouraged ordinary Americans to buy stocks on margin throughout 1929. He had told the press in March 1929 that the Fed's warnings were entirely unnecessary. By 1933, he was on trial for tax evasion. He settled. He paid. He walked. Albert Wiggin of Chase National had been short-selling his own bank's stock during the crash, profiting directly from the collapse he was publicly claiming to fight. He had made $4 million doing it. He resigned in 1933 with a $100,000 annual pension. Congress eventually eliminated it. After the fact, Richard Whitney, the man who made the theatrical bid for US Steel on Black Thursday, the man who became president of the New York Stock Exchange, was arrested in 1938. He had been embezzling funds from the NYSE's gratuity fund for years. He was sentenced to 5 to 10 years at Sing Sing prison. He served 3 years and 4 months. He was released in 1941 and worked quietly in Massachusetts until his death in 1974. Irving Fisher, the economist who declared that stocks had reached a permanent plateau, lost his entire personal fortune in the crash, estimated at $10 million. He never recovered financially. He spent his remaining years attempting to rehabilitate his reputation. He never fully succeeded. By 1933, US GDP had fallen from $105 billion to $57 billion. Unemployment reached 24.9%. 15 million Americans were out of work, not statistics. 15 million people with no income, no savings, and no safety net. Because no safety net existed yet. The Banking Act of 1933 created the FDIC. The Securities Exchange Act of 1934 created the SEC. Both were direct responses to failures the warnings had already identified. The architecture was built from the rubble, after the rubble had already buried everything. Here is the pattern, not the moral. The pattern. Every major financial collapse shares one specific structure. The institution responsible for stability becomes the instrument of fragility, not through malice, but through institutional deadlock at the moment that action was non-negotiable. The Federal Reserve in 1929 was not corrupt. It was paralyzed. Washington fought New York. New York waited for Washington. And while they waited, the system that needed a single decisive action got bureaucratic inertia, instead coordination failure. It has a different name each time. It has the same mechanism every time. The names on the doors change. The pattern doesn't. And somewhere right now, in a room with very serious people and very complicated charts, the same argument is happening again. Next week, the company that built the internet's infrastructure then accounted itself out of existence. The $180 billion implosion of WorldCom. and the one accountant who found the fraud before anyone was supposed to find it. Subscribe. You'll want to see this one.